As you all know, the tax system was built on integration, meaning whether you earn income in a corporation or personally, the taxes paid should be the same. I will be using a $100 bill to explain what the new tax proposal means to you and your pocket. Let's first look at our current tax system of an employee that earns $100 of investment income, and then compare it to a corporation that earns the same $100 under the same rules. Let's assume an employee earns $100 of interest from a GIC. Because this income was earned personally, there is no corporate tax. At the personal level, the employee will pay $50 in taxes, assuming all at top tax rates. This leaves him and her with an after-tax cash flow of $50, which is simply the $100 earned on the GIC less $50 of taxes paid at the personal level. This equates to a 50% effective tax rate. Now let's move to the same example using $100, but this time the interest income is earned in a corporation. The corporation will pay tax on $50, but $31 will be refunded when a dividend is paid out. This leaves a net corporate tax bill of $19. The taxpayer now has $81 left in his corporation, which is simply the $100 earned less the net corporate tax of $19. The corporation will pay a dividend to the shareholder of $81. The shareholder now has to pay personal taxes on that dividend of $37, again assuming all at top tax rates. This leaves him and her with an after-tax cash flow of $44, which is simply the $100 earned less corporate tax of $19 less personal tax of $37. This equates to 56% tax rate. As you can see, the same income whether earned in a corporation or personally, the tax rates don't differ much. In fact, the corporation is paying 6% more tax. I will now walk you through an example using the same $100 bill, but under the proposed regime. Again, the corporation earns $100 of interest. From our $100, we'll be paying corporate taxes of $50. As you can see, the same amount of taxes, but the biggest difference is the dividend refund, which no longer exists and now becomes a permanent tax at the corporate level under the proposed rules. The taxpayer now has only $50 in his corporation to distribute, whereas under the current system, he or she would have had $81. The shareholder now has to pay personal taxes on that dividend of $23, again assuming all at top tax rates. This leaves him and her with an after-tax cash flow of $27, which is simply the $100 earned less corporate tax of $50, less personal tax of $23. This equates to a 73% effective tax rate. The $100 bill that you once thought you had has now disappeared to $27, which means you no longer can grow and expand your business or hire more people or save for retirement. I call this the unfair tax plan, not the fair tax plan. It really impacts and targets everyone in the business. Whether you're an owner, a family member, or an employee, in one way or another, it will impact you. To stay up to date on this topic, contact your Zyphens advisor today and follow us on Facebook, LinkedIn, and Twitter.